Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Thursday, February 20th, 2020. And our top story today, what do you need to know when buying a home in 2020? And joining me now to discuss this and a lot more, Matthew Frankel is a senior analyst with Million Acres. Matt, welcome to the program.
Thanks for having me.
It's great to see you and thanks for joining us this morning. So I want to talk real estate. So we've had people talking about the general real estate market, kind of giving us a breakdown of what happened in 2019, 2020. But let's talk about buying a house in 2020. What are some of the things we need to know when looking to purchase a house in 2020?
Well, competition's high. Inventory's low. It varies around the country, but inventory is generally low. So if you're buying a house in 2020, it's much more important than usual to make your offer really stand out. The classic suggestion for this is to get pre-approved. If you're not a cash buyer, to get pre-approved before you even go shopping. It tells people you actually can afford to buy your house. But even that's not really enough anymore in certain cases, especially in some of these hot real estate markets where you see bidding wars. You could do a lot of other things to kind of boost your offer quality. For example, earnest money. A lot of places want you to say $1,000 of earnest money. If you put a $5,000 earnest check, it would show that you're a more serious buyer and let buyers know that you really mean business.
Matt,
be ready. Oh, good.
I'm sorry, Matt, real quick. What could you just define what an earnest check is? What that means? Some in the audience may not know.
Sure, perfect. So when you go to buy a house, in addition, this is separate from your down payment. When you submit your offer, you are generally required to submit a check for, the amount varies by market, but think a small amount, $500 to say $2,000, along with your offer to show that you're serious. And in the event that you have an accepted offer and you don't end up closing on the house, that money goes to the seller. It kind of is kind of a guarantee, not a guarantee, but it kind of gives them incentive to take their home off the market and sell it to you.
Okay, well, and that's a good, I guess, a good carrot, right, to incentivize someone to deal with you. And Matt, I didn't mean to interrupt you, but I want to ask you. You know, you mentioned inventory, and you know we've covered on this program the general real estate market. Are there areas of the country that you're following that maybe have more inventory or less inventory than some of the others?
It's an inventory crunch kind of wherever you go, but I'd say places where you're seeing a lot of job growth. Think kind of the Sun Belt region, like the Carolinas where I am is an example of where you're seeing a lot of inventory crunches. I'm a real estate investor and I'm having a tough time finding properties right now because of low inventory issues. So anywhere there's a lot of job growth, anywhere there's an affordable real estate market, because the really high cost markets, say San Francisco, New York, haven't really had a great year or two. So people are kind of flocking toward affordability. And if you go somewhere where it's affordable and jobs are growing, you're going to see competition.
Right. And that, I mean, we're like the markets are, you know, Denver as an example, I think is one where the market's really picked up. And people, are people still moving? And that sounds like an odd question, but you know, when we were chatting with someone who kind of covers the real estate market from a macro sense, it seems like maybe people are kind of slowing down their moving, and they're not necessarily moving across the country, and they're getting more tied down to where they are. But what's your perception about that?
Well, you have to remember that the millennial generation is just reaching kind of their peak family formation years. So even if they're not moving necessarily across the country, you're going to see a lot of kind of shifts from renting to owning, because if they're forming a family, want to have kids, things like that. I was in the same situation a few years ago. A 2-bedroom apartment isn't going to cut it anymore. So you're going to see a lot of, and the millennials, bear in mind, is the biggest single subgroup of our population right now. So that alone is driving a lot of demand. People are moving across the country for jobs and things like that, but you're right. It's not as much of an issue as it once was, especially with the concept of remote work. But you're going to see that big millennial group really start forming households over the next decade or so.
Yeah. So I interrupted you, but you were talking about, and I apologize for that, but you were talking about kind of the sense for the market and buying a new home. You talked about getting pre-approved in these earnest payments. any other things that buyers out there, whether they're first-time buyers or investors like yourself, should be thinking about to make that purchase?
Just be ready to act. Once these homes are flying off the market in a day or two in some of these areas, so be ready to act, have your realtor ready to go, and make your offer appealing. One thing I've done is remove the appraisal contingency. What that says is if the home appraises for more than your offer, you're willing to make up the difference. It kind of takes another uncertainty out of the seller's equation. So things like that you can just do to make your offer stand out, like unique things like that.
And Matt, what about, I know these homes are flying off the shelves, but what about assessing, for example, the air conditioning or the units, maybe the plumbing? I mean, how does that factor into? Because last thing you want to do is get into a situation where you're investing in a money pit, right? And you've seen The Money Pit with Tom Hanks, right? That was a horrible movie. It was a funny movie, but it was really, an example of what could go wrong, though very extreme.
Right, and I've accidentally invested in a money pit or two myself, so I know that firsthand. No, under no circumstances do you want to waive your right to inspect. That's different from the appraisal contingency. So you always want to make sure you do your due diligence. I advise having an inspector on call, so like I said, you can act quick when the time comes. A shorter inspection period is more attractive to a seller, but you definitely want to inspect. I don't get involved with certain issues like foundational issues, plumbing issues. If a house needs completely new plumbing, I generally won't pursue it any further. But things like that, you definitely want to know about. So under no circumstances, get rid of your inspection, and also have some specialized inspectors on call. Like you mentioned, the air conditioning. You want to have somebody who specializes in that ready to go.
Yeah, and last question, Matt. You mentioned pre-approval, and how likely is that, and what should people be thinking about when they approach a bank or a lending institution? Because it doesn't necessarily have to be a bank. It could be a lending tree or someone like that, which is an example of a third party that could lend money, or So how challenging is it in today's credit environment?
It's challenging. First thing people should know is the difference between a pre-qualification and a pre-approval. Pre-approval is essentially going through the entire mortgage application process. So it's not just about your credit score. That's definitely a part of it. But during the pre-approval process, the lender is going to want to look at your employment, your income. You're probably going to have to produce tax returns, pay stubs, things like that. They don't want to see that you have stable employment. So you're going to have to go through the whole process. So that's why it really tells a seller that you're a serious buyer if you've gone through that entire process. And it shortens the period between when you find a home and when you can close on it if all of that's already done.
Yeah. Well, Matt, I want to hold you over. When we come back, we're going to talk to Matt about the mortgage rates. We've seen a decline in mortgage rates. We're going to get his opinion. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We're talking to Matt Frankel. He's a senior analyst with Million Acres. Matt, thanks so much for sticking around this morning.
No, thanks for having me. It's been fun so far.
Yeah, well, we're all about fun, entertainment, and education. So we appreciate you staying with us this morning. We know you have a busy schedule. So let's jump in. Mortgage rates, all-time lows. What are some of the things you laid out a strategy for people buying homes in the first segment, but let's talk about those mortgage rates and things that consumers should be thinking about as they take a dip.
Well, the average mortgage rate is about 3.7% right now, but what most people don't realize is how much that can vary by credit score. You need about a score of 620 to get a conventional mortgage right now, and that's FICO score. But if you only have a 620, you're looking at an average of about 4.7%. Whereas if you're a top tier borrower, which is generally considered a 760 or above, you're looking at about 3.2. Over the course of a loan, that could make a six-figure difference in the amount of interest you pay. So yes, mortgage rates are at record lows, but there's a big gap between strong credit and low credit. And if you're in the lower credit tiers, it could be worth it to take a few months and really buckle down and work on your credit before you apply.
So let's talk about that. And I love the fact that you talked about the variance in percentages and what that can mean, because in the retirement industry in particular, fees matter. And just like it does in your business, the more you have to pay to borrow, which is exactly what an interest rate or a mortgage rate is, it's the cost to borrow, the more it impacts and the more you're going to spend out of your pocket as part of that payment on the mortgage. So that's important. But how do you said work on your credit. What can consumers do, just as an aside, what can consumers do to improve their credit today?
Well, there are a few things you can do to really boost your score in a hurry. The one that most financial planners give is paying down your debts, which obviously paying down your credit cards and loans and things like that is great, but it's not always practical for everybody. So if you have trouble paying down your debts, an alternative is to raise your available credit. This is kind of a credit hack that I always like to share. If you call your credit card companies and ask for higher limits, it has the same net effect of lowering your debt to credit ratio. So that can instantly boost your score by a few points. Another thing is just to let your accounts age. If you're thinking about closing an older credit card, don't do it. 15% of your FICO score comes from the length of your credit history. So just waiting a few months by itself can boost you by a few points. And so debt repayment, increase your available credit, and just let your credit report age are three really good ways you could have a meaningful impact in just a couple of months.
Yeah, those are big hacks. And those are hacks that not only impact mortgage lending, but also if you're going to buy a car, if you're going to buy a big ticket item, take a loan, that's important to know. Matt, you mentioned FICO, but there are different credit agencies. Do the other credit agencies factor in, or is it just the FICO score that really matters?
Well, the FICO score is used by about 9 out of every 10 lenders. There's another, the distant second is called the Vantage score. They both have the same general framework, and FICO scores are produced by your credit information from all three major credit bureaus, TransUnion, Equifax, and Experian. Mortgage lenders take the middle one, so it's worth checking all three of your credit scores. MyFICO.com is a really good place to start to see what your lender's actually going to see, because a lot of credit cards come with a free credit score, but that's just one of the three, and you want to know what your middle is.
Yeah, that's certainly important. Many people out there watching may think about just with these low mortgage rates, and I know that it all is dependent on your FICO score, but let's assume that you have a decent FICO score and you're going to go ahead and reamortize or refinance your loan. Maybe not reamortize, refinance your loan. What are things to think about? Are there fees? I imagine that there are fees that necessarily need to be paid to some of these folks that are helping you along the way do this.
Yeah, and fees have come down considerably, especially if you look toward an online-based lender, more of a newer company, like say like a Rocket Mortgage or something like that. And a lot of these online-based banks are even waiving origination fees just to get mortgage business right now. So that kind of brings me to another really big point, which is to shop around. The FICO formula specifically lets you rate shop. It's common knowledge that if you apply for credit, it can hurt your credit score.
Yeah.
But with mortgages, if you apply for a number of mortgages within a 2-week shopping period, it's considered as just you applied for one. So shop around. You'd be surprised at the difference in interest rates you get offered, and even a seemingly small difference, say 0.1% in APR, can make a huge difference over the course of the loan. So shopping around is definitely worth doing, especially, and make sure you're looking at your APR, which is your annual percentage rate, instead of just the interest rate, because that includes the fees.
Right, it includes the fees that you're going to pay to a mortgage broker. Is that who it is that would
You'll
be
see
the intermediary?
Sure, you'll see an origination fee, which is paid to whoever helps you along the mortgage process, be it the bank directly or a broker or things like that.
Last question, and this was a big issue in the 2008 credit crisis, I think. The securitization of loans, not speaking well today, but also redlining, and that's illegal. But how has that been kind of squeezed out of the system? I mean, how do lenders figure out, and you're not a lender, but you're involved in these transactions, how do they figure out who to lend to? I mean, the FICO score is important. They obviously want to see your salary history and other things, but I mean, how have they squeezed out some of those extraneous things that maybe jeopardized the whole mortgage and loan market?
Sure, it's definitely more of a set formula now. I mentioned conventional loans, which is what most people use to buy houses. And there's more clear underwriting criteria, as in if you have a certain credit score, you need a certain number of months of expenses and reserves, you need a certain debt to income ratio. It's more of a broad picture, and if you're really weak in one area, you have to be really strong in the others, which is something that was really lacking in that 2008, 2009 timeframe. So they definitely they want to see cash reserves. They want to see enough income to justify the loans, which is the big difference between now and then. And they want to see that you meet all of their criteria, not just one or two, not just credit, but credit, income, employment history, and cash reserve, and your assets. So it's more of a broad picture that they use now than they did in the mid-2000s.
Yeah, so you're not buying a $1 million home and only earning $40,000 to $60,000, and that's an exaggeration, but that's essentially what happened, where people did not have the monies in terms of earnings to supplant these costs, and the whole pyramid kind of crumbled. So, but really interesting, Matt. Really appreciate you coming on the program, and look forward to having you back a bit later, Matt. Have a great day, and we'll talk to you very soon.
All right, thanks so much for having me.
And that wraps up this episode of BRN AM. Hope you found it educational and entertaining all at the same time. Hey, have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, and so much more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.
But if you're tired of the same